Hello, hello. Welcome to Zoe's Treasures. My name's Tracy. Hello, Pixie Thrift, Southern Charm, Mystery Labs. How are you guys doing, Molly's? It's good to see you guys. Tonight we are talking just basics of tax. So Tuesday nights are the tax talk nights, and I try to bring a different tax topic every week. So, well, hello. Tonight I thought we would just do back to basics. So we talk a lot about Schedule C and business taxes. I just want to take it back and let's just start at the very beginning, personal income tax. And we're not going to go through like how to calculate your personal income tax, but just understanding some of the basic terminology and concepts on how a tax return kind of flows. So if you understand your personal one, which is important, then you can start to see how your business return kind of merges, that Schedule C, how it merges into it. So that's what we're going to do tonight. Thank you for sharing. Always happy to answer questions, so please put them in the chat. If you do have questions, make sure there's a question mark so I can easily see that in yellow, and I will try to answer any of them that I can. Before we get going, I want to talk about two big things coming up this week. I've got way too many shows scheduled. Don't know what I was thinking, but we're going to do it. However, tomorrow night is our new seller surge raid train. We do this once a month. We have 6 new sellers. We actually only have 5. There was a last minute schedule change, but we only have 5 tomorrow. Still super excited about it. It is going to start at the normal time of 5:50, and each brand new seller will have 20 minutes to show their stuff and kind of get used to the raid train. So come and see that, bookmark it. You can search New Seller Surge, and you'll see all the people that are on that raid train tomorrow. So really excited about that one. And then Thursday, this is going to be a fun one. I am doing the Halloween costume contest giveaway raid train. Let me see. Let me make sure I'm getting. I know one of the conductors, but let me make sure I'm getting the other one correct on that. Let's see. Of course, I can't see it. It is. Hold on. It is CG Boomerang Echo and I want to say JJ Shopper. I may be incorrect because it keeps covering it up and I can't read it. But really excited about this. This is Thursday, 5-minute giveaway raid train. I'm giving away, everybody on the train has to give away at least $25 value gift card item, whatever it may be. And we all have to be in costume. So I'm not going to tell you what I'm going to be. I finally decided on a costume, and looking forward to it. So you got to come join us. I'm going to be on at 7:05 on Thursday. So come see me then and get a chance to win a good giveaway and see what costume I picked out. And then Friday morning, I have my normal chat show, and we're going to have some fun. I'm going to try to do some like fun Halloween type stuff since it is Halloween. And talking about giveaways, let's go ahead and get one going. Let's see if I can run all of them tonight. I'm only going to be on for about an hour. Our first giveaway is, it's not in here. It is going to be a bird postcard. So you're going to get a bird postcard for the first giveaway. That is up and going. Okay, so let's talk taxes. 1040, your basic tax return. To start with, I thought we could talk about a little bit of fun tax facts. Let's just get some tax history. I am primarily sell in the vintage decor category, so anything vintage antique I think is kind of cool, along with some fun history. I got to get this. Sorry, you guys. I got to get this off the screen. All right, that bothers me on the bottom of the screen. So I went and looked up some cool tax facts. Some of them I already knew, but I found some others that I thought would be, this is kind of cool. So federal income tax was enacted in 1862. So it's been around quite a while. And that was enacted by Lincoln to fund the Civil War. Well, everybody after the Civil War started throwing a fit. They're like, you can't tax us. It's the whole reason we came over and created this country, right? We didn't want to be taxed, along with some other stuff. So it got repealed in 1872, but they came back in 1913. So with our 16th Amendment, brought taxation back to us, and it has been here ever since 1913. So kind of interesting fact, in 1913 is when the first Form 1040, that should be your familiar name to you. That is a tax form we all fill out every single year. That was introduced in 1913. So what's that, 120 years ago? And when it was introduced, 350,000 people filed taxes. You know how many of those people were audited? 100%. every single person in the year 1914, so it was introduced in 13, first tax returns actually got filed in 1914. There was 350,000 of them, and every single person got audited. That would really suck. Let's compare that to like more recent times. So 2024, less than 1% of people get audited. So I think that's kind of like telling. It's kind of a fun fact. We all worry about screwing up our taxes, and at the end tonight, I'm going to close with like the common mistakes people make. But we all worry about this, and we're like, oh, well, that's a red flag. It's going to make me get audited. And less than 1% of people who file tax returns now get audited. So just kind of putting that in perspective. So we talked about 1913. Let's see. How about this? Dumb question. Do I have to file personal taxes on? So Pixie Thrift, yes, you do file personal tax return. Depending on what type of business you are, if you are a sole proprietor or a single member LLC, then you will file a Schedule C, which is part of your personal tax return. If you are incorporated, S Corp, LLC, multi-member LLC, those are different types of business tax returns. Another fun fact I want to talk about, you are very welcome. You guys, please feel free to ask any questions you want. The IRS is what brought down Al Capone. You may have heard this before, but this is a good lesson to everybody. It wasn't racketeering, it wasn't murder, drugs, whatever he may have been doing. I don't know everything he did. It was tax evasion. Tax evasion is what got Al Capone busted. So the moral of the story is, if you are doing anything illegal, you do you. I don't want to know about it, but make sure you're filing your taxes. Because it is a common charge that they will throw on top of whatever else once they catch you. So it's just a way to, just letting you know. And then final fact, if you ever wonder why CPAs cost so much, especially your tax CPAs, the tax code as it stands 2 years ago, the tax code as it stands 2 years ago was over 70,000 pages long. 70,000 pages. So your tax CPA maybe doesn't need to know every word, but needs to be familiar with a good chunk of that. So just to kind of, think about how much knowledge that would take. We're not going anywhere near that level of knowledge. We're going to go back. I'm going to talk a little bit about just the common structure of your tax return, common phrases, and things you should know. At the end of the day, no matter if you do your own tax return, you have a CPA, you have a bookkeeper, you go to H&R Block, go to wherever else to get your taxes done, you are responsible. Your signature is on that tax return. Now, if you go to H&R Block, they'll offer for additional money, oh, buy this, it's like your tax protection. And I think even like some of the online tax prep software will say, hey, spend another $50 and you'll get tax protection. Salt Rock Mercantile, you got that first giveaway. Congratulations. For what do I have to provide to my accountant for tax season? Molly, you need to provide a good record of all your income, all of your expenses, and a detailed record of your inventory. Specifically, what came into inventory, what went out of inventory, and what your inventory is at year end. A good count, a good value. So those are the things you would need to provide them. If you guys are interested, I have talked about expenses and about what to give to your accountant in more detail on other shows. I will also be repeating it as we work our way through tax season, but you can always go to YouTube. Everything I do is streamed on YouTube. It's right up there, so Zoe's Treasures. Yes, everything on Excel would work. That's probably one of the best ways to give it to your accountant. So you can always check out past shows and listen to them if you would like. All right, so I was saying that your 1040 is your responsibility. No matter who does it, you can buy protection. However, that protection ultimately is not going to do a whole lot. What you are buying is assistance from a professional to help if you were to get audited. The IRS doesn't care if you bought that or not. The IRS is going to say, you signed your return, you're responsible. Since we're responsible, it makes sense that we at least have some understanding of it. If you're not the type of person to do your own return, cool, that's okay. I'm a full proponent of going and hiring somebody to do it, but you should understand it. You should be able to look at it and say, oh, this looks really funky. Something's not right. Even if you can't pinpoint exactly what is not right, you should be able to pick out like, hey, yeah, that's about what my income is. Yes, that's about what I expected for my tax liability to be. So let's talk about kind of the flow, some of the key terms. So all income tax returns start with the basics, name and address, right? Super simple. If you're filing with a spouse, if you're filing jointly, we're going to talk about the different types of filing statuses. If you are filing with a spouse, make sure that your names are right, your social security numbers are right, and always list one of you, pick who's going to come first, always list that same person first. So if the husband's name is the first name on your return, the first time when you got married, the first time you filed, you put your husband's name first, keep it that way forever, for as long as you are married. If you start to switch it back and forth, it confuses the IRS. That actually is a red flag at the IRS if you start switching those names back and forth. If you switched them, don't stress. I mean, it's not an automatic you're going to be audited or anything like that, but it does confuse the IRS. So if there's issues later on, if the IRS has questions about the return, that it just throws their systems off. Now, maybe as we move forward, AI gets better, all of that. That might not be an issue, but I have seen that more times than I can remember in the past where, for years, the husband's name comes first, and then all of a sudden they switch it up and put the wife's name, and it just throws the IRS into like a tizzy fit. So make sure that you put the names in the right order and keep them that way. All right, so that's the names. And then after your personal information, super easy, we all know our address. We get to dependents. You need to list your kids, right? If you have them. I've took some notes on dependents. Here, let me find where I wrote that down. So the IRS actually has some really strict rules on who is and who isn't a dependent for your tax return. Your next door neighbor's kid that is always at your house eating all your food, your pet, all of those people are not dependents. Dogs, Southern Charm, there you go. Nope, sorry, you can't claim the dogs. They probably cost as much as a child sometimes, but unfortunately we can't. What the IRS says, they have kind of this 5 rule. There's a flow chart you can look at in the guide, and they kind of have these steps that you go through. So first off, it's son, daughter, step or half of any of those. So son, daughter, stepsister, stepbrother, half sister. If you are responsible for them in your home, grandchild, you could even have a parent as a dependent in certain circumstances. What do you do when you sell your own items that you don't buy? Do you estimate a value? When you sell your own items that you do not buy, if they are part of what IRS considers a collection, which is clearly defined, there's a whole bunch of different things that are defined as collections, things that you inherit, sports cards, stamps, antiques, art, those do not go on your Schedule C. You do estimate a value, and those are reported a little bit different than your business assets are. They are considered investments such as like stocks and bonds are investments. But to answer your question in the most simplest form, yes, you would estimate a value. So going back to dependents, so there's a few more that are listed in the IRS, but basically any type of a child that you are caring for. They have to be under 19 or under 24 if they are still in college, or disabled. So they have to meet this. And this isn't like, here's 5 rules and you got to meet one of these 5 rules. No, you got to meet all 5 of these rules to be able to claim this person as a dependent. So they have to have that relation, son, daughter, brother, sister, half step, grandchild type of relation. Under 19 or 24 if they're in school or permanently disabled. Hello, Thrift. They do not provide more than half of their own support. And this is an important one. I've done tax returns for people where their 8-year-old made more money than I made. They were definitely, that 8-year-old child was providing more than half of their own support. In most families, you don't see this, but it's a consideration if your child has significant investments or income. Number 4, they do not file a joint return. And I know you're sitting there thinking, well, why would my kid file a joint return? But family situations have changed nowadays, right? You can have mom and dad and their 16-year-old daughter, who maybe they signed off to get married and they're living in their house, just because she's a 16-year-old daughter, she's a daughter, she's under 19, but now if her and her husband are filing a return, that disqualifies her for being a dependent of the parents. So they can't be filing a joint return with somebody else, and they have to live with you for more than half a year. So those are the 5 basic rules. You have to meet all of them to claim a dependent on your return. Now, as everything else with the IRS, they like to just keep us on our toes. So there are some exceptions and some minor, like nuanced rules to that. I gave you the most basic description, but like lived with you for more than half the year, there's a few exceptions, a few minor things like certain circumstances that the IRS does approve. But I gave you the kind of high picture that applies to most people out there. So that's dependents. So tax return so far, we got our personal information, we have our dependents. Next thing we get down to is figuring out what are we filing? What's our filing status? Am I a single person? Am I, you know what, let me start another giveaway real quick. This one is ephemera, and that's going now. All right, so am I single? Am I married? Married filing separate. We're going to talk about that one. That's like the kiss of death right there. Married filing separate. Am I a qualified widower, or am I head of household? So you can be any one of those. Let me come over. I thought I took notes on each one of those. I don't think I did. Single's easy. Let's talk about what they mean. Single, you're just a single person. It's just you and you alone filing your tax return. That's probably the easiest one out there. Married filing joint, you and a spouse filing together. Another pretty straightforward, simple one. Now with various types of marriages, it does get a little confusing, but again, we are following federal law, not any state-specific law. This is federal tax. So you and a spouse married together and filing together. Then you have the option of married filing separate. I, as a CPA, would never recommend this unless it's some far out unique situation. I said just a few minutes ago, this is the kiss of death. Married filing separate disqualifies you from most of your refundable credits, most deductions. Your standard deduction sucks. We'll talk about that in a minute. It's just basically the IRS put it out there, but then they kind of put it there as a way to punish you. It's like, yeah, you can do this, but if you do it, we're going to make it really, really bad for you if you do. So we don't really see married filing separate, except in circumstances that maybe you're legit married, there's some really unique things, absolutely cannot file with that spouse. But again, that's one of those things that most CPAs will try to steer away from. In weird situations, there's other things you can do to mitigate just complicated relationships. So single, married filing, joint, married filing separate. We have qualified widower, or what's it called? Surviving spouse is the other term that the IRS uses. That's a pretty straightforward. If you were married and your spouse dies during the year, you would be a qualified widower or a surviving spouse. So that first year, instead of filing a joint return, there is a special classification for you for that very first year. And then we have head of household. Head of household is kind of the confusing one. That's the one where I might be single, but I got some kids, I've got dependents of some sort here that I'm providing the care and the home for. Now, I'm not going to go into all the rules around it, but basically, very high level, if you are single, you're not filing married, filing joint, you are single, and you have dependents, you pretty much qualify for head of household in the highest level. Again, there's nuances with every single IRS rule. But that's kind of your way to figure out what you are. Now, if you and your spouse are married and you're like, look, dude, I love you, babe, you're hot, you're sexy, you do everything right, but I don't want to file my taxes with you. You're kind of stuck. You really don't have a choice. You kind of got to file married filing joint. Your only other option is that married filing separate. And we already talked about, we don't want to do that. unless we absolutely have to and we have no other choice, right? I see, and this is a question that I see a lot. When I was in tax practice, this was one of those ones, or even now, my adult kids will call me and they'll be like, hey, my friend wants to know, can they do this, whatever. And a lot of the questions that I see are, I split up from my husband, I left him, I left him in October, we're now in February, I got to file my taxes, so I'm going to file married filing separate. We're not, okay, so if you're not just married together 7 years, then you would be single. So again, we're going by federal law and whatever federal law defines as married. So it's just one of those things. And that's why I mention it so much, because it's one of the questions that surprisingly I hear so much. And there's a lot of bad advice floating around that, oh, just file married filing separate. It's okay. It's not really okay. Once you go into a marriage, and I'm not a marriage counselor, I'm not here to preach about marriage, but once you go into a marriage, one of those things you got to think about is taxes. And if you decide to dissolve that marriage for some reason, you got to think about taxes too. Who's going to sign? How are we going to file? Like all of this stuff. So kind of keep that in mind. Hopefully you're not in that situation. But all right, so personal information dependents. Now you know what your filing status is. Why is your filing status important? Because the IRS will say you get a standard deduction. We're going to talk about deductions in just a second. But you are going to be assigned a specific amount of money that you can take off of your income tax based on that filing status. So that filing status is really important. Golden Hour Vintage, you got that giveaway. Thank you for being here tonight. So we're going to come back to deductions, but just kind of keep that in mind. But let's talk about, your deduction. How do you know if you're even supposed to file a tax return, right? Maybe you didn't make a lot of money. Do I even need to file a tax return? So the way to figure out your tax return, if you should file, there's actually 3 tables in the IRS guidance. The very first table is based off of your standard deduction. And if you are single, if that standard deduction, this is for 2024 because they haven't published 25 rates yet. If you're single and in 2024 you made more than $14,600, you have to file a tax return. If you made less than that, you don't have to. However, we're going to get to the exception in just a second. Quick question, I might have missed it. If my child just turned 18, but they were 17 for most of the year, can I still follow the... you should be able to, as long as you meet all 5 rules, because it's under 19. The age is under 19 is the second rule. So yeah, it's not an 18, it's under 19. And as long as you're dependent, didn't provide more than half their support, and they meet all of the 5 rules. So the IRS says, based on your filing status, you get to take a standard deduction. And that standard deduction is tied to whatever your filing status is. Single, it's about $14,600. Married, filing jointly, $29,200. Head of household is $21,900. These are all 2024 numbers. Why does this matter? Because this is money that's basically tax-free to you. This is money that you don't pay income tax on. And if you make less than that, the IRS says, hey, if you're a single person and you made $10,000, you don't even need to file your tax return. Go have fun. We're going to talk about that, though, because that could be tricky. That's the first table. The IRS then has another table to determine if you are supposed to file or not. So the first one is based on that standard deduction amount and how much money you made. The second table talks about all these really unique situations. You're over 65, you have this type of income, you're disabled, you do this. I'm not really going to talk about that because they're very specific situations, and the IRS kind of outlines each one of those. I'm going to assume we don't fall into that category. It's usually a small population that falls into that category. Then there's the third table. This is what the IRS calls special situations. If you fall into any one of these special situations, you must file a tax return based on the number that the IRS lists in this table. One of them is if you are a reseller. That table says if you're a reseller and you make more than $400, you must file a tax return. So what does this mean? I have two tables here. One is saying I'm single and I have to make at least $14,600, And the other saying, but if you resell and you make $400, you have to go with the one that's lower. So if you're single, you made $10,000 at your W-2 job, you don't need to file a tax return. If you're single, you made $10,000 at your W-2 job, but you also made $500 on whatnot, guess what? You got to file a tax return. So kind of understanding that should help you determine if you should file or not. Now, there is a discrepancy. It's really weird in the IRS tax code. Actually, not surprising. If you think there's over 70,000 pages and they make one update, think about all the other updates they have to make throughout that tax code. There are 3 tables to talk about what the income requirements are. They say $400. But if we go to our self-employment guide put out by the IRS, it says $300. So there is actually a discrepancy within the IRS guidance. So I, as most CPAs would, say we're going to be conservative and say if you make more than $300 instead of the $400. The IRS could pick which one they want to enforce. Unfortunately, that's the way they work. All right, so that's your do I need to file? What happens if you can't file? We all know April 15th is our big tax day, right? What happens is getting close to April 15th, you're like, I don't have my stuff together. I haven't got a CPA yet. I didn't listen to Tracy when she told me months ago to get my stuff together. And now it's April 14th and I don't know what to do. There is an extension. Most of us have heard of them. You can file an extension. It's on form 4868. You don't need to memorize that. Quick Google search will tell you what form to use. And you do need to file that by April 15th. So you file that by the due date. If you owe any tax, pay it in at that time. You got to estimate how much you owe. Send them that return, that extension, along with some money, and you buys yourself 6 months. It used to be, I remember in my parents' generation, when they would do taxes, it was like taboo to do an extension. So you may hear grandparents or older generations saying, oh no, don't file an extension. That's kind of old. It's outdated information. Extensions are super common, like super, super common. A lot of people file extensions. It's not a red flag anymore. The IRS really doesn't care. Think about the number of returns that they have to process each year, and they process more and more returns with less and less employees every single year. So they're pretty cool with extensions as long as you're paying the money you owe and you do file it at the end of that 6 months. They're good with it. I have nothing against, like, as a CPA. Heck, if you need to file it, file it. There's a lot of reasons why you may need to. Sometimes it's just you need time in order for your CPA to finish it. Maybe you hired a CPA late, so this is something to think about. You may be the most organized person in the world and you've got all your financial records together and you're good, but maybe you're a procrastinator and you hire your CPA, let's see, January, February, March, maybe around the middle of March, you hire your CPA and you're like, yep, that's a whole month. He has 30 days or she has 30 days to do my tax return. Guaranteed, that CPA is already booked out well through April 15th. It is October, almost November. Tax CPAs now are already having meetings with their clients and booking clients' tax returns for next season. So if you're a procrastinator, don't wait till the very end to get your CPA, or you will be filing an extension and it will be pushing things out for you. Let's do another giveaway really quick here. This one is, this is a bird postcard. This is a pretty one. Look at that pretty bird. That's number 3. All right, so we talked about extensions. Let's talk about deductions and refundable credits. These are 2 terms you're going to hear a lot. We already talked a little bit about deductions. There are 3 types of deductions: standard deduction or itemized deduction and above the line deduction. Your standard deduction is what we just talked about. That's the amount of money the IRS says, hey, you as a married couple, you get $29,200 because we know living is expensive. We're not going to tax you on that. We're going to be a nice guy, right? They could raise those. They should. But they do raise for inflation. Usually every year it's adjusted. But that is your standard deduction, okay? Then you have what's called itemized deductions. An itemized deduction there's special things that maybe you pay for during the year that the IRS is going to say, hey, if you pay all of these things and the amount that you pay is bigger than the standard deduction, you can prove to us that it costs you more to live, then we'll let you take the bigger amount. We'll let you take that itemized amount. So itemized includes things like mortgage interest, real estate taxes, charitable contributions, casualty and theft losses, investment expenses, state and local taxes, which you'll hear called SALT, state and local tax. So if all of those things combined equal more than your standard deduction, so for a married couple, if I want my mortgage interest, my real estate, if all those things are more than $29,200 of my standard deduction, I'm going to take the bigger one. Because why? Why do I want the bigger one? This is money that comes right off of my income that I'm not taxed on. So I want to make that the biggest number I can, right? So this is something that I think a lot of people have questions around. They're like, well, should I itemize or should I take standard? It's really simple. The biggest number. You take the biggest number. If you have a good CPA or accountant, they'll help you figure out what that is. The standard deduction, it's published every year by the IRS. You can go to Google and say 2025 standard deduction amounts. I don't know if they've posted them yet for 25. They should. We're towards the end of the year. But you'll know what the standard is. And then you're itemized if you have those expenses. So let's start thinking about this. This becomes important as you progress through life, as you have various life changes, things happening. You can go from 1 year taking the standard to itemized and back again. But if you're a renter, say you're 25 years old, you're just starting out your career, you rent, you don't really give to charity too much, maybe a little bit here and there, but not any big significant amount. You don't have real estate taxes. You don't live in a state with state taxes. You don't really have anything to itemize. You're just going to take standard, okay? But let's say a couple years go by, you meet the man of your dreams, you get married, you buy a big old house, and now you're sitting on $11,000 a year in real estate taxes, mortgage interest at some outrageous amount, and now you're married, you got to be this responsible adult, you're tithing to your church, you're giving to Goodwill. Wow, all of a sudden I got all kinds of stuff that I can itemize. All of that can add up and help me reduce what I'm ultimately taxed on. So that's your difference between itemized and standard, okay? Then we have what's called above the line deductions. The IRS realizes that, hey, maybe you're that 25-year-old renting an apartment and you don't itemize, but there are some things that you should be able to take advantage of, such as student loan interest or health savings accounts. These are two examples of deductions that are included on your itemized, but they also the IRS will also let you take them as a standard deduction. So this is an above the line deduction, just a little bit extra that you can take off of your income. So those are three types of deductions. I started this by saying we have deductions and we have refundable credits. Two very different things. So your deduction is not a dollar for dollar reduction in your taxes. If you have $1,000 deduction, itemized deduction, standard deduction, and you're in a 22% tax bracket, then that means that's worth $220 to you. So for every $1,000 I spend on my mortgage interest when I itemize, hey, Monster Mama, you got that giveaway. Congratulations. Thanks for being here. So we just talked about itemized deduction. So for every $1,000 that I'm spending in real estate taxes, and I say I'm in the 22% tax bracket, $220 of that money is actually saving me taxes on my federal tax. Or every $1,000 of mortgage interest I pay, I'm actually getting a $220 tax savings for that, okay? Now let's look at our standard deductions. I'm single, my standard deduction is $14,600. If I'm in the 22% tax bracket, I can multiply 22 by that $14,600. That's what it's saving me in tax dollars. So it's not a dollar for dollar deduction, dollar for dollar reduction when you're talking about a deductions, standard, itemized, or above the line. But then we start talking about credits. And credits, again, I'll get to these in a minute. There's 3 types of credits, just like there's 3 types of deductions. Credits are calculated after you figure out what you owe in tax. Now, they're worth dollar for dollar. If I have $1,000 credit, that's taking a full $1,000 off of my tax bill. So what's better? I'd rather have credits because that gives me more bang for my buck. I get dollar for dollar value versus a deduction. I only get the percentage that matches my tax bracket value, okay? So let's talk about what are credits, because we already know what deductions are. So what are credits? 3 types of credits. We have non-refundable, refundable, and partially refundable credits. So non-refundable credits are things like the adoption credit. So there's special credits out there that legit, how they got on your tax return or how they showed up and became eligible for you to take is that some lawmaker wanted to pass a bill that had nothing at all to do, let's say the adoption credit. Some lawmaker at some point in time wanted to pass a bill. Doesn't matter, Republican, Democrat, doesn't matter. They wanted to pass a bill. The other lawmaker said, okay, we'll sign your bill, but I want something that I want in there too. So we're going to put some adoption credits in the IRS code, and I'll sign your bill over here about cars. And this is how they get in there. So sometimes they seem odd and weird, but it's the way for politicians to get things that they want put into law. So they just attach it to something else. We end up seeing it on our tax returns a lot of the time. So non-refundable credit, an example of that is an adoption credit. I'm not going to go into the whole story, but if you adopt a kid, you could, if you adopt a child, there are special credits that you can take in your tax return, okay? Then we have fully refundable credits. Most of you probably have heard of this one, earned income credit. Your earned income credit is fully refundable. This means that I can have 0 tax bill, get an earned income credit, and now get money back. I could have let's say that again, a 0 tax bill. I have 0 tax liability. I don't owe any more in, the IRS doesn't owe me. Then we calculate our credits. And if it's a refundable credit, such as your earned income credit, now the IRS is just going to give you free money. That's what a refundable credit is, free money from the IRS. Then we have partially refundable. There's some education credits that fall into this category. There's a hodgepodge of miscellaneous ones. And what this means is depending on your income, you may or may not be able for a refundable credit. They phase out. The more money you make, the less refundable it becomes to you until you end up being disqualified for it. So that's your difference between deductions and refundable credits. I know that's a lot, but we're going to kind of pull this together in a second and make it make a little more sense here. So let's try to do that. Let's recap. I'm going to start another giveaway really quick. Okay, another giveaway's up and going. What is this one for? Oh, 2 vintage postcards. That is number 4. Okay, so let's kind of pull this together. What does this look like and how does it affect your business ultimately? Yes, I want the EIC, the earned income credit too. That's another one. Credits, a lot of credits are phased. As soon as you get to a certain income level, you do not qualify. And we're going to talk about why this is so important to use a reseller in just a minute. I'm getting there. Thank you, Golden Hour. I appreciate that. All right, so let's just kind of take a step back, and we're just going to think of the flow of your income tax. We have income, how much money you made, right? As a business, when you file your Schedule C is just another form that's attached to your 1040. On your 1040, we have income. It's your W-2 income, anything you made on investments, if you're investing in stocks and bonds, whatever it may be, any businesses you have, all that income, all the money that the IRS wants to tax you on is going to go into income. Then we get our standard or itemized deduction, right? We take all of our income. The IRS says, okay, you can take off that money for living. I know you got to live, so we're going to give you a little break. So you take off that standard deduction. Then you get to your taxable income. Okay? We're at our taxable income. Income, all of our income, all our worldly income, including now, for the first time ever, cryptocurrency, just as a fact. So income minus either your standard or your itemized deduction gets to taxable income. Then we're going to figure out, we're going to add in any extra taxes. Why? And you're sitting there thinking, wait a minute, what am I adding taxes for? When we do our Schedule C, we have to calculate our self-employment tax. I talked about that, I think, 2 shows ago, maybe last one, I don't remember. We have to add in our self-employment tax. So we have our taxable income. Let's add in that self-employment tax. If there's any other taxes, there's a couple weird ones out there. You have to put it on there. And then we take our credits. So now we get down to those credits, right? So we figure out what our tax liability is. The IRS says, hey, here's your total number. Here's your taxable income. Here's your self-employment tax. And then you go to a table, or if you're doing it on a computer, it's all written into the program. Okay, your taxable income's $100,000. You're going to owe us $20,000 in tax. And you're like, oh, wait a minute, that's a lot of money. What credits are out there? What credits can I take? Because I need to reduce that some more, right? So you have how much you owe in tax. Now those credits come in. Earned income credit starts reducing that $20,000 down. Now maybe you probably didn't qualify if you made that much money for earned income, but let's just say you did. Now maybe you owe $15,000 in tax. Then we start looking at the college credits that are out there. There's a whole host of different credits, and it starts pulling that down, hopefully, till you hit 0 or you're getting some money back. So that's kind of the big flow of it. What I want to talk about and kind of pull together here is, how does this tie into your Schedule C? Why is knowing your personal stuff important when it comes to saying, okay, now I'm a reseller all of a sudden, and now I've got this business income that I got to put in here? Well, one, we just talked about income, all our worldly income, which includes that Schedule C. When we talked about our Schedule C, income minus our cost of goods sold, minus whatever we sold, right? Minus all those great expenses, shipping, home office, car, all that stuff, till we get to our net income. We want that net income to be as low as we possibly could make it. We want to take our mileage, our home office, because that net income is what goes over to your personal return that you're going to get taxed on. Yes, we want it to be 0 if we can. 0 or less. Legitimately, obviously, we're going to follow all the rules, but yeah, that's the goal, is to get it to be as low as you can, because that income number is now going to go to your personal return. If this is your first year reselling, and maybe you're in a tax bracket where, you're a single mom, you have 2 or 3 kids, and you qualify for the earned income credit. Y'all, if you're not familiar with the earned income credit, this could be anywhere from, $1,000 to $8,000 of refundable free money from the IRS. If you are in the tax bracket where you're getting, say, let's cut it in half. Let's say you're getting $4,000 a year every, the beginning of each year, say every April, from an earned income credit. And you're used to that. And you're like, yeah, I go to H&R Block, they do my taxes for me. I don't have to worry about the details. The White Owl, congratulations, that giveaway is going to you. But now you're reselling, you stumbled upon Whatnot, you're working hard in your W-2 job, you're barely making ends meet, and you're like, I'm going to sell on Whatnot. And all of a sudden, you make some money on Whatnot, it could easily knock you out of the bracket for any earned income. You may earn enough on Whatnot, you may only earn $3,000 on Whatnot and knock out that $4,000 refundable credit you got. Now, that's a big hit, right? That means you're at the end of this, you're down $1,000. And you're down $1,000 after you're busting your butt all year on Whatnot. It's good and bad, right? If you just look at it on the surface, you're like, geez, what did that do for me? But you're also building a business. You're building growth. You're building a future. So yes, you do have that kind of the growing pains and that adjustment, especially in that income bracket. But if you know that this is a possibility, you can be talking to H&R Block or your accountant well ahead of time, and you're not surprised come April. You're not like, oh, shoot, what happened to my $4,000 refund, right? Or worse, you're not sitting there in April saying, I normally get $4,000 back, but you're telling me I owe you? What's up with that, right? So understanding how Your income is going to affect your credits. Understanding how your filing status affects that deduction is really important when you start mixing in these variables of business income. Making $600 per show now, only like $150 if I'm lucky, whatever that threshold, yeah. So I know it's a lot of information, and I mean, I've been in this for a long time, so like I can merge it in quite easily. It's just like a daily thinking about this. And if you're not daily thinking about it, you're like, wow, this is a whole lot of stuff. I mainly just want more of an awareness point of, I probably need to talk to somebody early on, because this could really affect what's happening on my personal side. Your business income totally changes in multiple ways that tax return. We talked about the credits, these refundable credits, college refundable credit, adoption. There's different types of college credits. There's like 3 or 4 of them out there. The earned income credit, child tax credit. All of these are affected by income, and they can be phased out. And sometimes that phase out amount is a lot lower than what you would think is a reasonable amount. So knowing that, knowing like, hey, I'm a middle-aged mom, dad, you know, we're a married couple. We have a kid that's a senior in high school about to go to college, or maybe a junior in high school. I'm about to start filling out FAFSA forms. I'm going to now become eligible for college refundable credits on my tax return. I need to start thinking how my income affects that. If Whatnot's not your full-time income, guess what? You have control over that income source. Maybe make it a little bit less for a year or two before you fill out your FAFSA to see how much money your kid's going to get for college. Or when you're trying to figure out these refundable credits, maybe making a little bit less on Whatnot, pulling back, might be the best bet for you. Or maybe you're already in an income bracket that it doesn't matter, so I can go full force with Whatnot. I can't tell you the answer to that, but this is kind of where you got to start thinking. This is how these two worlds, the business and the personal and taxes, are going to merge into each other. We got a question. Not sure if this pertains to the compo, but at what point should one consider an LLC? This is my absolute favorite question ever. If you have been around me anytime, just, I don't know, go get a cup of coffee. I know you've heard my rant before. You do not need to consider an LLC based on earnings whatsoever. Just because you're in business does not mean you need an LLC. It is not a one-size-fits-all. Not everybody needs an LLC. There's a whole set of unique facts and circumstances to determine when and if an LLC is appropriate for you as a business. If you are a single person or a married couple, I consider them the same for tax purposes. Creating an LLC does zero for you tax-wise, because you're going to file the same tax form you file as a sole proprietor. Now, if you want partners other than your spouse, you have investment property, you're looking to hire employees, and there's a whole host of other reasons why an LLC may make sense. So for an LLC, what I would suggest is don't jump into it blindly. Go talk to a financial advisor, an attorney, and a CPA, or a combination of those three, and lay out what your plans are. What are your goals for your business? What's the current structure of your business? Do you plan to have partners? You know, where are you going with this? How much money are you making? Do you plan to hire employees? Like, go and talk to them about all this information and look at what those goals are, and they can advise you whether an LLC is really an appropriate move or not. Be forewarned, when you create an LLC, you are filing incorporation papers with whatever state you live in. This requires an annual recertification or re-registration. Each state calls it a little bit different, but it is more money you are spending every year. You must keep separate business records. You should be doing that anyways, but there is more of a divide between your personal and your business life. If you decide one day you wake up and you're in an LLC and Whatnot is not for you, and you decide, screw it, I don't want to deal with this anymore, I can't stand the shipping, and you're a sole proprietor, that's all you have to do. You have to say, done. But if you're an LLC, now you actually have to file paperwork with your state to dissolve the business. So it's kind of like getting a divorce. So before you go into it, just like before you go into a marriage, do all your homework. That's my advice on an LLC. And the reason it's kind of like this hot ticket item for me is there is a lot of misinformation going around, and I hear it all the time on Whatnot. I also see it on any accounting software. You scroll on Facebook, create your LLC, $99. I'll help you do an LLC. Just take a breath, go consult with somebody, make sure it really fits your goals and purpose and strategy for your business. That's it. Whatnot and you are still dating. You don't need to make the commitment yet. I love that. I'm probably going to steal that from you. Okay, so let's see, where are we? 9:20. We got a little bit of time here. I'm going to do another giveaway real quick here. What do we have this time? Oh, we have 2 old vintage photographs. Number 5. Let's talk about some common mistakes. Not exclusive. There we go. It's complicated. All right. Common mistakes. These, I actually went to the IRS website. So what I'm about to read to you are like kind of mistakes that I'm going to go over straight from irs.gov. Almost all the information I give you comes from irs.gov, one of their publications, or something very similar type of a source. So mistake number 1, filing too early. And you're like, whoa, wait a minute. I get my W-2 on January 2nd. I'm roaring to go. Yes. If all you have is a W-2, that's probably not a problem. But now you're on Whatnot. You probably have a 1099K that you're waiting on Whatnot. Probably got one from PayPal. Maybe you're on Etsy. Maybe you're on Posh. You need to take those 1099Ks from all of that. They have till, I didn't write the date down, I want to say the end of February to send those out. So if this is your first year doing this, and you're one of those people who are like, I got my W-2, I'm going to go and file and get my refund, I'm ready. Whoa, plan on waiting a little bit longer. Because filing too early, the biggest mistake the IRS says is the people that file too early are not including all of the paperwork. What happens if you do that? Now I got to file an amended return. That just costs me more money. And it sucks, and it's a headache, and it's not worth the hassle. So sit back, chill. Come the end of March, file your tax return. Just put it in your head. I'm not even filing until March. And maybe not then. Maybe I'm going to do an extension and file in June. That's okay. It's okay. Missing or wrong social security number. It's like at the top of the page, it's like name, social security number. Really hard to like skip over that box, and all of your tax stuff is tied to a social security number. So I'm not really sure why this is at the top of the IRS's list unless that they see it over and over. But let's just make sure that our social security number is on our tax return. It's like when you were a kid and you had to put your name on the test so you can get credit for the test. Same thing. Just make sure your social security number's on there. Misspelled. Thank you, the White Owl. That is so sweet of you. I appreciate that so much. Number 3, misspelled names. I don't know about you. Well, wait a minute. I do have a funny name story. But by the time, that's for the White Owl. Thank you. By the time you're an adult and you're filing taxes, you probably should have your name down. Even if it's weird like Zoe with an X, you probably should know how to spell it. But I think what the IRS is referring to here is that the spelling of the name doesn't match the Social Security card. That's an issue. This could be a real thing. True story. My name's Tracy. When I was first born, my mother spelled it Tracey. So my Social Security, my birth certificate, Tracey. When I became into, kindergarten, first grade, around the time when I started to learn how to write my name, my mother decided she didn't like that spelling and she made it Tracy. She just dropped the E out of it. It wasn't until I was getting my high school diploma, like getting the paperwork together for my high school diploma, that I realized that I spelt my name wrong my whole life. I did end up correcting it legally, but that could be an instance where your name does not match your Social Security number. So that's something they see quite frequently. Misspelled names. Number 4 is wrong information. You just don't know what you're doing. just put the wrong stuff. You got the wrong numbers. You got your W-2. You got your 1099-K. You just filled the forms out wrong. This is where I say, go to H&R Block, get an accountant. Or if you feel confident to do your taxes with TurboTax or any of those softwares, they're all about the same, y'all. There's not one that's better than the other. Free Tax USA, I have used for years. Legit free software, just as good as the stuff that cost $89.99. It does it all the same. But you must understand what you're putting in and putting it in correctly. When they give you a question, if you're going to do it yourself, which I fully think everybody's capable of doing taxes themselves, the heat of 5 sons, congratulations on that giveaway. Thanks for being here. Just make sure that you're clicking the little like information boxes if you don't understand a question. I still click a lot of them. Tax stuff changes. Well, hello. Tax stuff changes all the time. So just making sure you're putting the right information in. And then number 5, the biggest, the heat of 5 sons. You can always watch on almost every single one of my shows. We stream to YouTube, and anybody can always watch on YouTube for free too. So all of my shows, unless I'm not running through my computer, but that's pretty rare, and I try to say it when I'm not recording. Incorrect filing status. That's one of the biggest mistakes they see. What are our filing statuses? Our single, married filing jointly, married filing separate, head of household. Using the incorrect filing status is one of the biggest errors IRS will see. And then math mistakes. This one's probably kind of going down on the list because we really don't do it pencil and paper anymore. I know I'm dating myself. I remember like legit going to the post office and you would get your tax forms and then you would sit there with your pencil and you would fill one out, make sure it was right, you would do all your math, and then you would take a nice clean one and do it in ink. I am that old. I am like paper tax form old. So they don't see math mistakes so much anymore now that it's all computerized. But final one, find as big as, did you do that too? That makes me feel better, Southern Charm. Final mistake that they see, unsigned forms. And this can even be unsigned, remember bands, unsigned even on electronic returns. So if you go somewhere to get your return filed, like H&R Block or an accountant, the CPA, there's like forms that I forget the name of the form, but there is like an electronic authorization form that you physically have to sign. They have to make you sign that form to have a copy of your physical signature that they will, your CPA or H&R Block or whatever, will scan in and attach to your tax return. So if that's not getting signed, your tax return is invalid. If you send in a tax return that's not signed, it is invalid. It doesn't count. It acts like you never sent it in at all. Don't be scared to do taxes. Get a good CPA or go to, look, H&R Block gets a bad rap, but I will say over and over, I worked there as a CPA. There is highly educated people working in H&R Block. Now there's duds too. Look, there's duds everywhere. But there are a lot of highly educated people. They have a great training program. I, in most cases, would speak very highly of them and would recommend them, even for more complicated taxes. And they're probably cheaper. They're still expensive. You're still going to pay a good $300 to $400 minimum at H&R Block for most returns, but you're going to pay $300 to $400 an hour for a CPA. So, balances out. All right, where are we here? Let's do one more giveaway. And we're getting close to the end. You guys got any questions, throw them in there. We're getting close to wrapping up here. We're going to run this giveaway. What is this one? We've got some bookmarks, some motivational cards, and I'll put in a bird postcard too. This is number 6. How about, all this time we've been talking about federal tax. In addition to your federal tax, there are many states that just love us so much that they want to tax us. They just want more of us because they think we are such great citizens. However, there are 9 really kind and generous states that don't tax us whatsoever. So here is the list of states that you either want to live in or want to retire in, particularly retire. Why retire? Think about it. Following a normal progression of life, by the time you get to retirement age, you should have, yes, Georgia, Georgia, Pennsylvania, they want all the money, trust me. And I'll tell you a horror story, my own personal horror story here in a second about taxes. And I lost my train of thought. But, normal course of life. By the time you get to retirement age, you should have a little nest egg. You should have like a 401k or some Roth IRAs. You should have some retirement savings. You should have some investments. Maybe you have a home that you raised your family in and you're going to sell that house and downsize. So you should have some money, right? That's the goal for all of us. Have a big old nest egg that we can retire and go travel the world or do whatever it is that we enjoy. So before you get to that point, you want to make sure that you're in one of these states that doesn't tax all of that stuff. You've been paying all this tax your whole life. Why pay even more? So my personal goal is to move to Tennessee before I retire. So the states that you ultimately would love to live in that are currently state with no state taxes are Alaska, Florida, Nevada, South Dakota, great state of Texas, Washington, Wyoming, New Hampshire, and Tennessee. So there are 9 of them. If you're ever curious, what are those? It's a quick Google search. What states have no tax, state tax? And now you know what states you can live in. So we have about 2 minutes left on this giveaway. And I have gone through all of my notes. So are there any more questions? I'm kind of looking to see if there's anything I missed here. No more questions. Nope. Okay, cool. You're all tax experts. Awesome. Moving to Tennessee. That's where I want to do. Oh, I was going to tell you my horror tax story. State taxes. While I don't particularly address state taxes when I'm talking, because every state has different laws, generally follow federal taxes for the most part. However, some states are like, they're mean. Some states are mean. We moved to Pennsylvania. We have state tax. Kind of sucks after living in Florida for quite many years, not having to pay state tax. Then you move to a state that has it. Anyways, file the tax return. I am a master procrastinator. Absolutely. I have mastered the skill of putting off everything I need to do, like in adulting, in like real life. I am great at business. I am great at my job. But my husband will attest to you that I kind of suck at being an adult in every other area because I hate paperwork. So I filed my Pennsylvania taxes this year. I overpaid, which, I'll get to that too. I overpaid. I was expecting a refund, a significant refund, a little over $1,000. And they said, hey, Tracy, you didn't send me the W-2. Got a letter about a month after I filed. Send me your W-2. Okay, that letter sat on my desk and I procrastinated and procrastinated. And then I moved it to that side of the desk and then I moved it back. And then eventually they sent me another letter. And that letter said, guess what? You never answered us. Now all of your money that I'm supposed to give to you is now ours. You're going to get $24. So I am in a battle filing appeals with the state of Pennsylvania to get the rest of my freaking refund. So don't procrastinate. Don't do what I did. Bad example. Just do as I say, not as I do. I am retired, but not yet retirement age. Sold under my limit and always use TurboTax. Will it be much harder or just add your 1099 when you get it? That's all you have to do. You are actually any income you get from Whatnot over $300, just add it. You just pop it right in. Should be super simple. What about getting a reseller certificate so you don't pay tax on purchases? And since Whatnot collects taxes, we don't have to worry about that. Correct. So Whatnot handles all sales tax. So big burden off of our plate. Thank you, Whatnot. You can get a reseller certificate. You usually apply through your state. Who's going to get that giveaway real quick? Auntie Barbie, congratulations. Thanks for being here. You usually apply through your state. You can get it if you think it'll help you. There's absolutely nothing wrong with getting it. Do know that when you apply for your reseller certificate, it does come with filing obligations, usually at a quarterly basis. So there is some additional time and effort that you must put in every single quarter. I have not found it beneficial to me to do that, but I don't also feel like I'm purchasing at volume to where there's like a time cost benefit. However, that is an individual decision. And it's not like the LLC thing that I go off on a tangent about. If it makes sense to you, do it. Hello, CG. So I was going to tell you one other story, and I totally just forgot what other story I was going to tell you. I told you my Pennsylvania horror story. Oh, let's talk about, real quick here, before we go find somebody to raid, let's just talk about refunds, tax refunds. Because a lot of times, people are like, I got this big old tax refund. Isn't this wonderful? Look at this money. I get it. Every April, I get all this money. The goal really, your true and actual goal should be to break even, or even to owe a little bit of money. Like, I'm super psyched if I do my tax return, and I'm talking federal, if I do my federal tax return and I owe like $300-400, I'm like, yes, I got it right. Perfect. Why? Because if they owe me, if I'm getting a refund, that means that I gave the IRS an interest-free loan of my money all year long. I would rather keep all that money in my bank or reinvesting in my inventory than I would just give it to the IRS, right? There is no other system in this world, no other place that you're going to be like, you know what, I really like you. I'm just going to give you my money all year. You can do whatever you want with it. And then we'll fill out a bunch of papers at the end of the year and you can give me some back. Heck no. Like, there's no other like legit thing that you would ever do that with, right? So while a big old refund feels really good, you just have a whole year of missed opportunity and lost opportunity with your own money. So think about it like in that aspect. If you end up owing a couple $100, you did really, really good. How do you know that? How do you judge that? Doing your records all year long, keeping up with it, meeting with your CPA or your accountant or your bookkeeper on a regular basis throughout the year. Now, the exception to that is, we talked about refundable credits, right? So if you get that tax liability to a zero, or maybe you get the tax liability to where you owe $200 or $300, you're awesome. Then comes in those refundable credits, and the IRS is like, I'm going to give you free money, and that creates a refund for you. That's cool. That's good, because that's just free money from the IRS. That's not your money to begin with, right? So that's all I'm going to say on that, because a lot of people are like, they use their IRS as their personal savings, and I can just never wrap my head around that. Like, I'm like stingy. I don't want to give them any more money than I absolutely have to. So mixed fines. We talked about refundable credits, and I'll do a really quick recap, and then we're going to go raid. But you can go back and watch this at any time on YouTube, and you can get the full detailed version of everything. But a refundable credit is a credit that's calculated. So anyway, all credits are calculated after you figure out what your tax liability is. Then the IRS says, okay, here's some credits. Some are refundable, some are not, some are partially refundable, such as the child tax credit. For every kid you have on your return, there's a child tax credit. I think this year it's like $2,200. There's just some recent changes made on July 4th with the new bill that came out, changed it a bit. That, hey, it's free money from the IRS. They're going to give you, just because you have some kids, if you owe money, it reduces what you owe. If you don't owe any money, you just get free money from the IRS. Earned income credit. That's probably the most popular and widely known refundable credit, is the earned income credit. There's various college credits that are refundable. Those are some of the big ones. The adoption credit I think is partially, or is that a non-refundable? Adoption is non-refundable. So they need to do pet credits. Yes, there was a lot of people, but do you know how they would open themselves up to abuse if they allowed pets? That would just be, people do fraudulent things. So I'm going to leave you with this last thing we talked about at the very beginning. File your taxes. Don't get caught on tax evasion. Even if you're doing something illegal, I don't suggest that, not at all. But that is how they got Al Capone. They got him on tax evasion. The IRS guys with the gun. The coolest people, the coolest IRS guys, they're like law enforcement officers, are the ones that got Al Capone because he evaded taxes. So even if you're not on the up and up, file your taxes. All right, that's my words of wisdom there. Go do what you want, but file your taxes. We're going to go find somebody to raid. I have a bunch of shows coming up. I have 2 raid trains that I'm super excited about. Tomorrow night is my new seller surge. We're going to have 5 brand new sellers. Please check that out. And the very next night is the Halloween costume contest giveaway raid train. I am on at 7:05. I wrote it down. What time? 7:05. I have a really cool costume. Super excited about it. Come and see me. It is a giveaway raid train. CG Boomerang Echo right there is the conductor. A ton of people on this train. Everybody has a $25 minimum giveaway that we're doing. I think either like item value or like gift card value. And everybody has like 5-minute slots. So it's like a boom, boom, boom. And you get to like check out everybody's costumes. And I'm pretty sure the top 5 are going to be selected. And then viewers get to like vote and figure out who the winner is. So come and vote for me. Come check out my costume. Vote for me. And thank you, Mixed Finds. We have a request to go to I Love Discounts, which are some of my favorite people. So obviously we're going to go see them. And with that, y'all have a good Tuesday night. Thank you for being here, and we'll see you all again soon.
Honey, what are you doing?
Nothing?